Financials in focus once again. Futures here in the U.S. pointing to a mixed opening this morning, but it will be much about the financials ahead of the Capitol Hill testimony from Federal Reserve Chairman Jay Powell and Goldman Sachs earnings. Jay Powell will meet with the Senate today. He will have his Humphrey Hawkins testimony today with the Senate and tomorrow with the House. Financials got a boost yesterday after Bank of America reported quarterly numbers on the heels of strong earnings from J.P. Morgan Chase last week. And as you see, the markets were mixed at the close. Joining us right now is Hilton Capital Management Chief Strategist, bank analyst Dick Bove. Dick, good to see you.
Thank you, Maria.
Nobody knows the banking sector better than you. You've got bank stocks underperforming recently, certainly the broader markets, although we had a pretty good run just the last couple of days. What's your take on the earnings story?
Well, I think you're swinging between the yield curve and earnings. In other words, when people think about flattening or potential flattening of the yield curve, they sell these stocks. When they think about, earnings are actually pretty good coming in over the last few days, they buy these stocks. So the question becomes, what is the more compelling of the two when you look longer range? And I think if the economy does grow at the rate that people are projecting, bank earnings will continue to go up and the stock should be okay.
But is there a sense from your standpoint of better loan growth, a better backdrop? What do you think are the headlines right now in the financial services sector?
Well, yeah, I think it's very clear that loan growth has come off the bottom. In other words, it was doing really poorly at the turn of the year, and now it's starting to rise. But it's not uniform. In other words, you're seeing an improvement in commercial industrial loans. You're seeing a decrease in auto loans. So if the bank is more associated with lending to businesses, it's doing really well. If it's more associated with lending to the consumer, it's not doing as well.
So what does that mean for the regional banks? Because we haven't really heard too much from them. PNC reported on Friday it was a pretty good result, but later this week we'll get more of the regional results. So is this loan growth going to transfer to them? Yeah.
In other words, if you go a little bit downstream, a little bit further than the big regionals, and you look at the mid-cap banks, they're actually hitting the ball out of the park. I mean, they've got growth of 12, 10% in loans, whereas the big banks are struggling to get loan growth at the 2-3% level. So if you want to just move down a little bit from the big regionals and the big universals, I think you'll find a lot of good stocks.
Dick, we're 10 years into this economic cycle. It's the time when you got to start wondering if there's excesses building somewhere. Where's the next bubble going to happen that could end this expansion? Where do you see excesses, if at all, in the financial sector?
Well, I think it's quite clear that it's commercial real estate. I think that commercial real estate is a bubble. I think that you are going to see loan losses coming up in that sector. And if the economy were to weaken meaningfully, you would see a lot of loan losses cropping up at banks in that area. So that's the.
And what banks are exposed to that? You always have to wonder what banks are going to go down when the next exit boom ends. Yeah. Where is the concentration of commercial real estate loans?
Well, again, unfortunately, to contradict what I just said to Lindsay, the fact is that the biggest lenders in the commercial real estate market tend to be the mid-cap banks, right? So the net effect is they're doing extraordinarily well because that sector has done extraordinarily well. But if that sector pops, they're going to get hurt. No way to avoid it.
The quality of loans, though, has remained very strong, at least from what we've heard from the big banks, because there's this major concern that consumers are taking on more debt. But the quality hasn't really been impacted yet.
The only place where the quality of lending has been impacted is in the auto industry. In the auto industry, we're seeing a lot of subprime lending being done again, and we're also seeing deals being made with dealers of cars that are not very attractive for the banks. But in general, loan quality is extraordinarily good. Loan volume is increasing. Margins are stable. So from an earnings standpoint, the banks are not in trouble at all.
And then we've got Jay Powell testifying today. A lot of people are going to be wondering if he's signaling 4 interest rate increases this year or 3 interest rate increases this year. Does it matter that much to the banking sector if the Fed is doing 3 or 4? And what are you looking for out of Powell?
Actually, I'm looking for the president to take control of the Fed. All right. In other words, you've got 7 people on the board of governors of the Fed, in theory. There's actually only 3 there. 2 of the 3 were put there by the president. 2 more are now waiting for the Senate to approve them to be put there, and then there's 2 more still that the president will put on the Fed board. So
I
we'll
don't think
have
anybody
6.
wants that. The Federal Reserve is supposed to be independent.
I know, but it's going to happen. In other words, there's been a change in the head of the FSOA. It doesn't matter what these are. The head of the FOC is changed. The head of the FDIC is changed. The head of the NCUA is changed. The head of the OCC is changed.
Right,
the head
sure. Yeah, all new regulatory hits.
Yeah, every one of them have been changed, and all these people are bankers that are coming in as opposed to bureaucrats and laborers. And I think that I like the change.
Yeah, no, I
but the
think,
fact of the matter is,
well, it makes sense because he's rolling back regulations, and this is a whole new agenda. For these agencies. Yeah, for sure. I understand. Heads, let me ask you real quick before you go. Are the banks going to pay higher dividends, do you think, this year as a result of a better backdrop? They
will, but I think they're giving away too much capital. I think the biggest weakness in a bank balance sheet right now is that if you look at the capital, the common equity of J.P. Morgan, Bank of America, Citigroup, it's all down year over year. And these are capital-intensive businesses. You can't give away your capital if you need your capital to grow your business, and that's what they're doing. So from a longer-term perspective, I think they're making a big mistake here.
So and don't get sucked in, if you're an individual, into those higher dividends, which is the mistake that so many just regular Americans made during the financial crisis. I'm not saying these banks are going to go out of business, but many, my parents own these stocks because they paid high dividends, and then when the economy turns, look out below.
Yeah, you're right. Last time around, it was really painful.
Right. It's not just cutting the dividend; it's capital losses, and in some instances, all your equity was wiped out in those banks. But
yes.
I'll leave it at that.
Thank you so much. Great insights from you, as always. We appreciate it. Dick Bove joining us there.